Hello everybody, my name is Quinn Markwith, bringing you this week's MarketMaker.io Bitcoin market update. I'm going to start as always with this simple Bitcoin chart. Thankfully this time from a slightly different tone / angle, because Bitcoin did actually finally break out of this range that it's been trading in since the start of the year. Got above that $45,000 level, and now it can be argued from the technical perspective that downtrend that we've been in since November has come to an end, at least for now. So it did also take along market sentiment, unsurprisingly, along with it. For the first time in months, the market did flip into greed mode. It actually took to get above that $46,000 level, though, just yesterday before it finally switched greed, meaning that we can be confident that not only did the market reset structurally, fundamentally in the bearish months, but we've actually had a flip back into bull mode confidently once again. So why was this $46,000 level so important? Well, we discussed previously that this is the level where most of the short-term holders, these are the traders and types of investors that were responsible by definition for moving the Bitcoin price since the start of the year between that range, did on average actually purchase their Bitcoin at around $46,000. So mathematically we can say that they're in a bull market. The market as a whole, every cohort can be said to be in a state of profit. And so therefore, it's another way to argue essentially that we are once again in a bull market. So what we'd want to see to be even more confident is a retest of the $46,000 level, or some type of move past it that just leaves it in the dust. Because then we can say that the market is no longer teetering on that edge of slipping once again into a state of overall loss. So it looks like so far this thesis of seller exhaustion on a longer time frame has been playing out, unless of course we do get some type of major capitulation once again. Bear in mind the macro environment still is still riddled with risk. But for now we did see lower highs on the higher time frame, and so it's possible that we really do see a bullish continuation here. Also, concerning altcoins, they haven't really moved yet, which is what we typically want to see and do see when Bitcoin has gone through this sort of market reset, and when it's starting its fresh bullish move. We typically see alts lag behind a little bit. So ETH versus BTC, a good indicator for the altcoin market overall, continues to consolidate, hasn't really broken out yet. But if Bitcoin moves into the higher ranges of 50,000 to 60,000, we would probably expect to see that breakout at some point. So coming back again to the overall macro market risks. Typically, historically, Bitcoin has needed to see dollar weakness in order to run. It doesn't mean that we're going to necessarily need to see it again. Notably, we have seen over the last few days actually the dollar index strengthen just ever so slightly, and Bitcoin hasn't really seemed to care. So it's moving against the Dixie, at least on the shorter term time frame. But the dollar breaking out from this level is a bit of a tall order, because we would need to see the Federal Reserve, for one, either do something that the market doesn't expect, and bear in mind that the market is now pricing in some pretty aggressive hikes over the rest of the year, or we would need to see some kind of fresh geopolitical risks being priced in. That could come from some type of fallout with the Russia-Ukraine situation, causing commodity prices to spike even more. That could be one way that we could see this happen, because the tightening in the market would cause a new fresh round of capital fleeing to the dollar for safety. However, it can also be argued that that's all a bit of a tall order, and the whole scenario for this dollar the dollar index to be rejected here and actually weaken is still intact. So we're watching this closely, and if we get a rejection here, that would be very promising for the demand side of this equation, because we know that the supply side situation, as we've discussed, is very bullish. So much of the supply, in fact, the only other time in history that this much of the supply has been held by long-term holders was September 2020, before a very bullish period. And right now we're right back up to those levels. However, we do need to see follow through from demand, and so another period of risk on in the market, which is always typically characterized by dollar weakness, would probably be enough to see that kind of influx of demand once again into Bitcoin. Bear in mind too that yields have actually come up quite a bit, and so this means that a lot of the tightening that the Fed wants to do has already been done by the market. And so, while it could be argued that the Fed, given the inflation situation, needs to hike going forward, definitely a possibility, it can also be argued that they can't actually do as much as they're saying they can do. So it remains to be seen just how much they'll tighten, but either way, it's going to be difficult for them to shock the market enough, I think, for this dollar to really rally much. Again, we've also seen risk on assets such as ARK Invest and overall tech stocks start to get a bid, as we talked about last week. Their rallies are still intact, they're holding up, and so the narrative for risk on assets to have some breathing room over the coming months is still overall intact. Again, so I also wanted to make the point, one final point before we finish for this week, yield curve inversions. So it's all the talk in markets right now, and it is something very significant. It's, as we've discussed previously, if the yield curves do invert, it basically signals that the market could easily slip into a state of credit distress, and banks especially will have a hard time by definition conducting business if this yield curve inverts, because their whole business model of funding longer dated maturities with shorter term debt is threatened. So far, we actually haven't had the inversion just yet. And I wanted to make the point that sometimes it takes quite a long time, even after the inversion first happens, for a recession to be triggered. So see that yield curve inversions have historically coincided with periods of recession, but for example, in late 2000, early 2006, we had that inversion, and it wasn't for a good 2 to 3 years until the market actually went into a state of recession. So the same thing could play out here potentially. There's many people argue that commodities still have a lot of room to run. When you compare the commodities versus equities globally, they're still not that strong. So yes, they are strong, and that's significant for the real economy. It's significant for inflation. But versus equities, still a lot of room to run. Obviously, no one wants to see them run further. But the point is that the market does seem to be able to, at least right now, stomach some months, perhaps a year or so, of this kind of behavior. But we need to also acknowledge that the risk of a recession is heightened, given the situation with commodities, given the situation with the housing market, as we've discussed previously, and given this trend in yield curves moving towards a state of inversion. But that's all for this week, and thanks everyone for tuning in, and see you next time.